Joining us now to discuss the Treasury market, the Fed, and the outlook for rates, Rick Santelli and Steve Liesman. Who wants to start? You don't have any data for us today, I don't think, Rick?
Yeah, actually, there was some data a few minutes ago. Philly Fed Non-Manufacturing Service Index, but I can summarize. 9 out of the 12 months, that was December, 9 out of the 12 months this year were negative in the Philly Fed non-manufacturing, which really does raise some eyebrows. And the last 3 months are all sort of ganged up right around that -6 number. But it really does underscore something. We know manufacturing's had a tough time. The real issue is the service sector starting to slow? Now, I know that Philadelphia might not be representative of the entire country, but it's definitely something to keep an eye on, especially at a time where uncertainty seems to be the word I've heard most over the last several Fed meetings. And in a way, many investors are going to have to get used to something very new, something that was more predominant, Joe, when you and I were back on Wall Street, and that is kind of thinking for yourself as to where the economy's going, studying the fundamentals, because I don't think the Federal Reserve really is in tune in some type of crystal ball fashion with what may lie ahead. I think they're definitely scratching their head a bit, and it's understandable. You know, we've had basically almost 4 years of governance that, in my opinion, was way off the normal curve, the normal bell curve of what governing is in the U.S., and I think the silent majority spoke during the November election process, and I'm very confident that moving back to normalcy will definitely be worth a dividend with regard to the economy.
Steve, go ahead. I'm going to unleash you.
Well, I don't have much except that I think there's one aspect of the Philly Fed non-manufacturing index that I think underscores something that Rick was talking about, which is if you look at the outlook, that number is up strongly 2 months in a row. And I did check, by the way, the November number you see, which is the second bar to the right, is a post-election number. And it's one of my big themes for next year, which is this optimism that looks to have gripped businesses with the incoming Trump administration. But when I look at the whole setup for next year, I'm also hearing and seeing indices that suggest a lot of uncertainty. So my theme number one for 2025 is this optimism versus the uncertainty that's out there in terms of how the new fiscal policy will set up. It also creates a second kind of conflict here, which is the deficit hawks versus the Trump tax cut promises. You talked about that in the last hour with those two guests you had there, Joe. And finally, you got this other thing. You've got Fed rate cuts, which are penciled in. You have sticky inflation, but you also have fiscal policy. That's a three-way right there in terms of how all of this works out. And what you've had is you've had this anomalous, short-term, by the way, rise in the 10-year while the Fed is bringing rates down. To be fair, the 10-year fell pretty precipitously ahead of those expected rate cuts. But right now, it's on the way up. Go ahead, Rick. Sorry.
No, I didn't mean to interrupt. I just think that anomalous would be the exact opposite word I would use. To me, what's going on in the 10-year is reality. The unreality is that we ever spent any time under 4% for 2024. As a matter of fact, as we sit right now, 461, we're 9 basis points away from a new 2024 high-yield close, which was the third week in April at 470.5. And I fully expect that for 2025, we'll test 5%.